But let's talk a little bit about global developments, because that's where the action's been for most markets. Shane Oliver of AMP joins in for that. Shane, good morning. What do you think will happen later this evening? Will Ben Bernanke say something that will shock the market, or will it be one of those easing kind of statements that will give the market belief that liquidity is here to stay?
I think probably more likely the latter. I can't see Ben Bernanke wanting to upset financial markets because it will undo a lot of the good work he's done over the last year or so in terms of trying to push those markets higher as an aid to the US economy. My feeling is that Ben Bernanke is probably feeling a little bit more comfortable about the US economy, the jobs market. The latest figures look a bit better, but by the same token, I think, like the Fed president of Chicago, Evans, who said overnight that he's still feeling a bit nervous about things. We have seen this pattern in the past where the data looks good for the first few months of the year and then sort of tails off a little bit. So I think Bernanke would probably want to project some confidence, but not so much confidence that it looks like he's about to unwind QE3 or start tapering it off.
Morning, Shane. Even for people who believe that eventually a tapering off might happen, they believe that it might happen towards the end of the calendar, not immediately. Do you think, in that sense, global markets have breathing space for the next 5 or 6 months before any such event comes to the fore?
They probably do, although as we get closer towards the end of the year, I think markets will start to focus on it more. I think the key here in all of this is that when QE3 starts to taper off or gets wound down or even starts to come to an end, it will only be because the US economy is stronger. So many have long memories of what happened in 2010, where QE1 ended in March, 2011, where QE2 ended in June, and then, of course, the Operation Twist, which ended, I think, the first half of last year. After all of those monetary easing sort of came to an end, markets did have falls. So that experience, I think, largely, though, reflected the fact that when the monetary easing ended, it ended too early. It ended almost arbitrarily before the US economy was onto a sustainable footing. This time around, when the end comes, I think it will only be because the US economy is more sustainable. Therefore, it probably won't have as big a negative impact as we saw in 2010 or 2011. So yes, it's something that could cause volatility in markets, but I don't think it's going to cause the sort of setbacks we saw particularly 2 or 3 years ago.
So what kind of mood do you sense amongst investors towards equities right now? Are we in the phase where gradually more and more people are getting converted into the idea of being in equities or taking on some more risk?
Well, that's certainly the case. It's worth noting, I think Sir John Templeton, who was a US investor, once observed that bull markets go through 4 phases. They're born on pessimism, they grow on scepticism, they mature on optimism, and they die of euphoria. At the moment, I think we're somewhere between scepticism and optimism. In other words, the pessimism that was around a year ago has well and truly faded. There's a bit more optimism around, but there's also still a bit of scepticism out there. So investors, as you say, are sort of warming to the prospect of owning more shares, that they might be the place to be for the next few years. But I think we've still got a fair way to go. When you look at fund flows and mutual fund indicators and so on, they still suggest there's quite a lot of money sitting on the sidelines that can come into equity markets over the next few years to push markets higher. I certainly don't sense any euphoria that you normally see at market tops. I think we're a long, long way away from that.
What's your observation on the liquidity interest in emerging markets specifically, though, Shane? Because how much of the proportion of the money we're pulling would you say is courtesy what's been happening in the US and their policies versus what's happening in Japan? I mean, what's more important for an emerging market right now?
Yeah, that's a good question. Normally when share markets in the US, for example, start to rise, you start to see investors putting more money to work in the emerging world. Recently we've seen a little bit of that. The emerging world markets have rebounded, notwithstanding the volatility last day or so, but they have they have come up from their lows, which I think is a positive sign. I think the fact that you've got Europe sort of out of the headlines, so there's still issues in Europe, but the bond yields have well and truly settled down and we're not getting the flow of negative information out of Europe. The fact that you've got quantitative easing occurring in the US and the US economy, at least the private sector, particularly housing, looking stronger. Then you've got Japan, which seems to have almost come from nowhere for many, and suddenly seems to be back in the race again with a huge gain in the Japanese share market and lots of cash being pumped into the Japanese economy. I think the odds are some of that money will find its way into the emerging world, and therefore you'll see those markets pick up as well. The only thing I'm a bit unsure about is the dynamic regarding commodity prices. Last decade was associated with a huge surge in commodity prices, particularly benefiting Latin America. But that was on the back of 10% plus growth in China and very constrained supply. Now you've got Chinese growth 7.5%, 8%, so it's come down, and you've got an increase in the supply of commodities as a result of the mining investment boom we've been seeing. So commodities story not quite as bright. Therefore, I think when the flows go back to the emerging world, and they may be starting to do that, they'll probably be more discerning, probably focusing more on Asia as opposed to South America, given that Asia tends to be more a commodity user rather than a commodity producer.
The experience over the last month and a half also, Shane, has been that India has been pulling the most amount of money, perhaps second to a market like Taiwan in the Asian region. Has the mood changed around on India any when you speak to investors?
It's become a little bit more positive. Yeah, some of the sort of reform moves that have been announced in India have sort of, I think, calmed investors a little bit about the Indian outlook. We've also started to see the inflation picture, particularly over the last month or so, looking healthier in India, whereas, I think investors were thinking that it's heading towards very low growth and high inflation, and therefore not a lot that the Reserve Bank of India can do about it. Whereas now there's a bit more optimism around on that front, that inflation has come off both the CPI and the wholesale price index, and therefore there's more scope for the Reserve Bank of India to support the economy and perhaps cut interest rates further, which I think has sort of caused some investors to sort of look beyond the weak growth numbers and say, well, okay, they are weak, but now with inflation cooling a bit, that provides more scope for more rate cuts, and therefore some interest, I think, has returned. And likewise on some measures, if you look at pure PEs, India is still at in the sort of the top half of the range in Asia. It's still relatively expensive. But if you adjust those PEs, price to book values, for the return on assets and EPS growth, then India sort of looks okay. It's sort of in the sort of the cheap side of the equation. So I think that's also having an impact, that investors can see a bit of value in the Indian share market, and they're a bit more optimistic about the economic outlook in India. Therefore, you're seeing some of those fund flows return.
Shane, always a pleasure. Thank you very much for your time today. That's AMP Capital and how it's viewing the world. Not expecting any shocks from Ben Bernanke tomorrow.